Hello, YouTube. It's here. We're looking at a cup and handle, and we're going to find out whether or not it's going to lead to a new bull market, or if this is another bear market rally. We're going to face our final boss on Wednesday, or Jerome Powell when the FOMC meets. This will be critical because the pattern we're looking at here, or this cup and handle, going back to March, looking at the NASDAQ, we identified the same pattern where we were only at about 305 on QQQ. We were currently in bargain hunting. And as we update that chart, even only as of July, we went all the way up to roughly 370, which is basically where QQQ is now. And as we look here a little bit closer, it says performance chasing. Does that kind of signify what we've been doing in the market lately? I think so. And as we try to face this final boss, or Jerome Powell, there is something happening in the market that just isn't normal. The relationship between the tech performance and the bond yield has changed, which means if it's going to be a new bull market, man, we already know what we're looking for. I'm going to give an update to that this week, including some key numbers here. So make sure you stay tuned. We're going to go through all of that. But if the bond yields do continue to rise after the Fed, that's going to mean that they likely raised interest rates. So what is this guy thinking? We have a lot to go through this weekend. So let's not waste any time and jump straight in. There's a 98% chance they're going to hold interest rates flat next week, basically where they currently are. So the Fed is going to be meeting on Wednesday. But this week is about a few things. It's about inflation for Europe. It's about raising interest rates for England. It's about the Fed for America. You can note there's a star here, which means that's the most important thing happening this week. So because we're focusing on inflation and on central banks, I want to really focus on what I think Jerome could be mentioning. He's really scared this is going to happen. So far, it's tracking pretty close. This would be a repeat of Paul Volcker. So I think Jerome is going to toe the line, but I think he's going to hold interest rates flat. So if we zoom in here to a most recent, a more current period of time, we note that in 2004 to 2006, they jacked interest rates up at the fastest rate going back to the 1970s. That same period we're looking at back to here. The difference is that they pause for about a year. They get to 5.25, and then from July of 2006 to July of 2007, they hold interest rates flat, and then they cut, and then the recession comes. So we've gone up even faster this time. We've gone a little bit higher. We're currently here at 5.33. I believe Jerome was going to signal a pause, and that could lead to up to 12 months of bullishness. As a reminder, a pivot is bearish. A pause is not. And the reason why a pivot is bearish is because the Fed usually moves when something is broken. So right now, they're definitely breaking some stuff, but things are not yet quite broken. So these numbers are pretty scary. We went through this update last weekend, so we're just going to leave it here in terms of whether or not we're going to go to my bull targets, which I have here, or if we're going to ultimately go lower and get a big old nasty cut. So I think it really comes down to what people think. Is it currently 2007? Is it currently 2008? And I think we have a great show for you ahead, but I'm going to ask you for one big favor. If you could please consider smashing that thumbs up and subscribing to the channel, I would really, really, really appreciate that. I know I ask for it every single day, but it goes a long way to support the channel and to keep me motivated to keep doing these videos that I love doing every single day. So something I'm going to be paying particular attention to, because I'm now echoing two different moments where we could be going bullish, we could be going bearish. I don't know which side's going to win. We're going to go through an update right now, so please make sure you stay tuned. But I think it's really going to come down to what is in the SEP, or the summary of economic projections, because if a pause is currently baked in, and let's go back to that Fed tool. Let's just bring it up here really fast because I think it's important for us to look at it. So the reason why this is important is because, let me just close that one out. If we go out to November, we're expecting the same thing, 72% chance of a pause. Into December, we're looking for 60% chance of a pause, which means the market's basically looking for that pause. So what we want to know is whether or not in the new SEP, or summary of economic projections, the Fed kind of agrees with where the market currently is. If it does, yields should probably not go higher. They should be coming back down. But if the Fed says higher for longer, we're prepared to do more, blah, 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 we're probably going to get a sell-off, notably in tech stocks. This is very important because positioning is currently quite neutral. And we're noticing that this has not really been going anywhere. A month ago, we're neutral. A week ago, we're neutral. Yesterday, we're neutral. Today, we're neutral. Positioning is also changing here. So when we look to positioning, we note that the short sellers are almost going net long. This is the least short they've been, going all the way back to 2022. 116. The shortest before that is 118. So the trend is clearly here, where they go big short, double down, go net long. Big short, double down. Are they going to go net long? That'll be the big question. as we move forward and try to tell the story, what this really comes down to is whether or not we're going to track the 30 years of history or 3 decades, which would be a bearish scenario where the 10-year note's going to break out. As a reminder, we're looking at this pattern right here because this is not normal. Red line goes up, black line goes down. Red line goes down, black line goes up. Black line's a 10-year treasury note, and the red line is the NASDAQ. So if we're going to be getting that big, nasty bear, this goes back to July again, when I was presenting most of my thesis for where we could go on the monthly chart. As we look here to that same pattern, again, the W looking here, man, it's so close. We were looking for 4.336 to get claimed and to hold. We're at 4.334. So what I don't know is that close enough? Did we get the breakout? Did we close over the previous high? Not quite. Previous high is 4.335. We're 0.001 below. I don't know. I think it's kind of like close enough. So if we're going to get that big old nasty cut, or the 1, 2, 3, 4, 1, 2, 3, 4, that's what I'd be looking for confirmation. And we're going to go through this update at the end of the show. Please make sure you stay tuned. But we have roughly a 2% cushion for us to go back down and retest the monthly low before we actually crack bearish. So we're going to need to have a multi-percent decline this month. All right, moving forward, that is the bearish scenario. Looking forward to the bullish scenario, it's not all that complicated. We're just going to do what we normally do into the second half of September, which is sell off. And what I want to pay particular attention to here is that we do potentially get a micro lower low or a double bottom here going into August, September, and then, for October, we're looking for a little bit of a lower low. That could be on the Fed. That could be on a few different things. So that would really be this thing that I've shared originally back in July. I gave an update to it. And we're looking for our 5-step recipe. So our 5-step recipe is really what I am looking at to drive this next move. And I'm not really sure whether or not we're going to repeat the seasonality chart or if we're going to go for that big old stock market crash. I'm just honestly not 100% sure. So what does that mean? I'm going to be positioning for October. I'm not going to be positioning for September. Why? Look, Nike swoosh or just do it. So if we're going to be getting that cup and handle and it's going to lead to a pass, well, that kind of implies that October, November, December are going to be great months. Maybe we go back to all-time highs. God forbid, maybe even go higher. If we now look here to XLK, the story becomes a little bit easier because we already went to new all-time highs, went to all-time highs, had that same consolidation or an inside bar. And now we're just finding out whether or not this is a handle. If it's a handle on a cup and handle, we should be going higher. I'm talking new all-time highs. So XLK has different weighting than QQQ, but we note that QQQ looks pretty close here too. This is the pattern we were looking at. And if we go here to a line chart, man, it doesn't look all that bad. No, it doesn't look all that bad. And I want to show you one more thing now too, because if you think about what market probably got the most surprise this week, well, it's probably Europe because they had a surprise interest rate hike. So what actually happened in Europe? Let's have a look and see. So let's go to the DAX. Let's go to a 1-week chart. And let's go back here to candles. So we actually closed up by about 1% on the DAX. That's like pretty good. Why? Well, everyone's so effing scared that Jerome's going to raise rates again, or maybe one time more in the future. Man, the ECB surprised us this week. Market did not seem to care. So why? Well, I think it's because we're looking beyond these current hikes that the Fed is closer to being done than not. If we're going to go to 5.50 or 5.5% interest, and we're currently at 5.25, we're looking for an additional increase of about 5%. What does that mean? It means we've done 95% of the hiking, unless they're going to be going to 6% or higher. So, like, who cares if it's another one hike, 25 basis points? We're 95% of the way there. And this becomes a little bit more obvious when we look at this pattern here for the DAX, which I've been also using as a template where we have our cup, we go to new all-time highs, we have our handle, and then what do we have? We got a low, 456, 468, and then 564. We have 3 higher lows. We have these lower wicks. What does that mean? After they faced their final boss, or Christine Lagarde, man, the dip buyers are coming in pretty hard. They came in hard in March. You notice that by seeing the big tail here, and then 3 tails over the last 3 months. What are we digesting? Well, look and see where these wicks are going. They're going basically below the previous all-time high. Anytime we go below the previous high, they bid it up, they buy it up, they love it, they accumulate it, they hold on to it. We know that Europe has different concerns than America, but it's also cheaper right now. So it's not as good, but it's at all-time highs. So now if we go back and look at this a little bit objectively, let's go back here. Let's remove all the lines. What do we have? Well, if we dive down but rally back before the end of the month, man, that would form what? Yet another wick. And we have an inside bar here. So if the DAX is leading, maybe we can follow. If we now go back here to QQQ, we're going to notice something similar too. So I'm just going to delete everything so we can see it here. We note that we're basically digesting our previous tops right here, which acted as the pivot for us to hit those tanks, right? That was the bear market. So as we're backtesting this key critical area, which kind of formed our head and shoulders as we were going lower too, it's like really important we make sure that this is support. Otherwise, we're not building a staircase up support as we go higher. The elevator up usually leads to the elevator down. So to try to go through a little bit more, what I think the risk this week is after doing the live stream on YouTube is that I don't think people are really ready to wait. They're really getting either fearful or greedy, trading both sides of the tape when we don't yet have a clear trend. So what is that clear trend? That clear trend would be an inside bar break. So here I'm looking to my 5-step recipe, which we're going to go through right now. And then for the bears, we'll go through and talk about the bear market update as well, which I was wrong about, right? I mentioned I flip-flopped this week. Well, that's because I had a pattern. It's awfully close to playing out here as we look at this weekly close. We almost got a bearish engulfing. It's pretty close, but we didn't quite get that. So the recipe that I was looking for, or 3 red weeks, 1 dead cat bounce, and then a bearish engulfing, well, that happened in this yellow box, and this yellow box, and it did not quite happen here. So we'll give an update to that in a few minutes. But first of all, we want to talk about this big chart right here. Why? Man, if you look over here, maybe you pause the video. I got some numbers here. I did a little bit of math. And what does that mean? It means that if my current bull scenario is going to play out, we're looking for 2 specific things. Because we're halfway through the month, we just want to know if for the next 2 weeks or into the end of the month, we're going to hold the monthly low. That would be number 4 here. So number 4, number 4. And what goes after number 4? Well, it's number 5. So if number 4 holds and we hold that low, but we also go to a monthly higher high, that's how maybe we're going to have Santa Claus come to town. We could go higher. And the question is, how much higher? Because we can look at this move right here. That's one way of looking at it. Another way of looking at it is, let's just do the math here. So I'm looking at 2020. I'm looking at the number 3% decline, and that was 10% right here. So this 10% decline corresponds with number 3, or those lines we had down. And then the 50% rally is what I'm calling the move off the low all the way up to the high. So I got the numbers from there. I'm rounding them. So we got 10.5 as number 3 decline and a 50% rally off the bottom. And then I'm using a multiplier to find out what that number would be for 2023, right? Because computers do most of the trading. And if we follow the math, we usually find the answer. So here for number 3, we have a 5.5% decline. And I'm also assuming this monthly low is going to hold. Why? Because that's what the pattern tells us. So if we got a 5.5% move, it means we got 52% of the decline, which means that we should use 52% of the rally as our target. And what does that mean? Well, it means that we got basically 5,500 as our target. Is that a coincidence, or is that likely where we're going to go? There's one more thing we can look at here to try to understand how this 5,600 target could hit. It's by just looking at a Fibonacci extension. So we look here to our all-time high, all the way down to our low. And then we use an extension, which means we get a 161, and that gets us here to 560 on SPY or 5,600 on SPX. And now that we got through quad witching with $3.4 trillion expiring, I think we have to really make sure we are receptive to what the charts tell us. Not what we want to see, not what we need to see for our accounts to go green. It's what the market really tells us. This is a lot of premium. We talked about this on Friday. I think that now that this is over, what usually happens after a quad witching is something that I also want to be very mindful of. Usually we decline about 1% after a quad witching. So if that would happen, it would match the seasonality chart, but it would also match that 30-year chart for September where we have a big tank. So what does that mean? For me, it's pretty simple. Let's go here to SPY to try to keep the chart a little bit clean here. And I know a lot of people track SPY, so we're just going to focus on this one. That same extension number is 561 on SPY. So what are we looking for? Well, if we get a 1% decline, where does that get us? Well, a 1% decline gets us down here to about 438. We're still above the monthly low. We would have to drop by about 2.2%, almost 2.3% to really lose that low at 433.01. So it's really important that if we're going to track that 1% decline that I just mentioned, that we don't go down more than 2.2%. If we go down more than 2.2%, then it just means that this pattern is not a failed breakdown, which means that the previous month is the failed breakdown, but it's only a failed breakdown if we actually rally up and go to new highs. So that's really what I'm paying attention to here. We have about a 2% buffer, but as we know, the market moves fast. And if we had a 2% decline, excluding the dividend, it would basically just be 2 days like on Friday, and then the S&P chart is breaking. It's not quite broken, but it's breaking. And I already mentioned what I think those catalysts could be. I think it could be the inflation report. I think it could be the SCP from Jerome, or I think it could be just his commentary as well. Is he going to sound hawkish? Is he going to sound dovish? I think if he sounds dovish, the market's going to run. It's going to run hard. But if he does not do that, the bearish scenario was still here, where if we're going to get that big sour reaction for the month of September, I think it's pretty much close enough. We didn't get the perfect pattern where we get one green week with the dead cat bounce and then bear engulf. We got this, and it's almost there. We almost got a bearish engulfing on SPY. We got a 2-cent higher high, but we held the low. But by closing at the low, it means there's downside pressure. So if the downside pressure gets released and we do lose 43.73, or basically go below the 5% dip, and then also print a new low of the month, that's now how I see us getting down to that 10% cut, which is how we could replicate what happened here before. One cut lower, dead cat bounce, second leg lower. So that's really what I'm looking for going into this week. I want to finish off by looking here to our above or below. Actually, one more thing, sorry. I think we also have to pay very close attention to the dollar. Why? Because right now the dollar is trying to move up. If we look here to a monthly chart, what is this? It's a bullish pattern. So the dollar, if you're bullish on stocks, you want the dollar to be going down. And other than this trap right here, which means a violation of the uptrend, it resumed and went right back up. We're getting key pivots. What used to be resistance is now turning into support. That's usually bullish, which means the dollar might keep going higher. If the dollar goes up another 2%, that's going to hit the S&P. Look at the percent gain on DXY. It's up by 1.6%. And right now, the S&P is down by 1.55%. So whatever the dollar goes up, the S&P basically goes down to track it. The dollar goes down, the S&P goes up. I believe that if the Fed is done hiking, the dollar should go down. How much? I don't know. Might be a little bit, might be a lot, but we have to pay close attention to it. All right, very last thing for us to do here is going to be going through the above or below 50 DMA club. Why? Because now that OPEX is over, if we're already expecting a bit of a sour reaction, we just want to know whether or not, with the rest of the world reporting a lot of data, meaning Europe and US, after hearing from the Bank of Japan and Canada, we want to know whether or not we're strong or weak around the world. S&P, 1 day below, 1 day back above, 1 day back below. Man, okay, below right now, but not 2 in a row. QQQ, below for 1 day. SMH, below for multiple days. Volume's also coming in like we saw on S&P and QQQ. NVIDIA, back below. This is not terrible, but it's back below. We also noted that the Jensen Yang has been selling, so I don't know if that's adding on more pressure. I think it was largely OPEX related. Apple, below for a long time. Looking here to Tesla, over. So it's looking pretty good, looking like a leader. We move forward here to FXI, below. Does not look good. We look here to Microsoft, back below. A couple days back above, now it's back below. We look here to ARK, basically got a rejection here on the 50. We're looking at the blue line if that's not clear. And the DAX trying to get back over it, right? Trying pretty hard here. I'm not sure if it's going to get there. It's trying though, right? At least it's trying. XIU or Canada, back above, looking for a golden cross too. Emerging markets, not quite there. But I could see a W in the making here, right? It just has to actually W to get higher. Hasn't quite done that yet. And then the Nikkei, Nikkei looks good. Change in policy is definitely helping them. Ethereum, I'd like to see Ethereum rally and get over that area too. That'd be a key thing I'm looking for going into the Fed. Same thing with Bitcoin. Only has to rally up by about 1,000 points, $1,000, and it should get there. Very last thing I want to look at now is that another way to try to look at the breadth and depth for the broader market is by just looking at one key indicator here. Let's go to my YouTube list. Let's go here to these two different charts. It's the S&P above or below its 50 DMA. And right now, only 32% of stocks are above their 50 DMA. So 2 and 3 stocks are pretty weak. We just looked at the charts for global indices and major asset classes above or below their 50. But this right here tells us that the S&P 500 has 1 stock going up over its 50, and we got 2 going below. That's usually not a good sign. In the longer term, though, things look a little bit better. Why? because half the stocks are above their long-term price and half of them are below, which means we're pretty much at neutral, which is the same thing we're noticing for sentiment, positioning, and pretty much everything going into this market. So if it's going to be a new bull or a new bear, we're likely going to have to wait until we get to the end of the month to see whether or not this pattern is going to play out, or if the big bad bear comes back and flexes, destroys not only America, but the whole world. Thank you for tuning in. If you want to watch more, there's now a video queued up here on the left-hand side. If not, maybe you want to consider joining us for a 14-day free trial, because this week is going to be spicy. There's going to be a lot going on. You can come trade with me by going to thealgo.com. You can see all my private notes. You can see my exact positions and portfolio and all the stocks I'm planning to buy this week, because I do plan to buy some stocks. With that said, thank you so much for tuning in. I look forward to seeing you in the next video. Thank you again.